For decades, the Shanghai silver market has operated with a quiet autonomy that few outside institutional circles fully grasp. While New York sets the tone for paper contracts and futures, Shanghai's exchanges often reflect a separate rhythm, one driven by domestic demand, state directives, and layers of speculative positioning that rarely intersect directly with COMEX flows. At the start of this year, the gap between the two benchmarks began widening, initially by small increments, almost imperceptibly. But recent data now suggests that Shanghai silver is trading at roughly $115 per ounce, while New York lingers near $100. The $15 spread is not merely a statistical quirk. It signals deeper frictions in physical supply, cross-border logistics, and the arbitrage mechanisms that usually keep global pricing coherent. Market observers note that arbitrage, the traditional process of buying low in one center and selling high in another, appears stalled. Available reports indicate shipping bottlenecks, regulatory constraints, and inventory shortages that prevent traders from exploiting what should be an obvious opportunity. This raises questions about whether the gap is structural, temporary, or symptomatic of a larger imbalance in global silver flows. Underlying these numbers is a tension few outside professional trading networks witness directly: the divergence between the paper market and the physical market. In Shanghai, demand for actual metal bullion bars and coins is reportedly outpacing what warehouses can provide. Meanwhile, New York's COMEX remains anchored in contractual delivery schedules, where the physical side of the market has become increasingly thin. The growing discrepancy sets the stage for friction that could ripple beyond mere price points. Regulatory frameworks in both markets add another layer of complexity. Shanghai's exchanges operate under rules that prioritize domestic liquidity and strategic reserves, often creating artificial tightness when global flows would normally alleviate price disparities. In contrast, COMEX maintains a system designed around tradable contracts, with physical delivery as an exception rather than the rule. This structural mismatch means that the usual price equalization mechanisms are constrained, and what would normally be an arbitrage opportunity now feels out of reach. Traders familiar with both environments note that the $15 divergence is not just a gap in pricing, it's a signal that cross-border metal movement is increasingly difficult. Shipping costs, insurance, and regulatory approvals all add friction, but reports suggest there may also be deliberate positioning at play, with some actors holding back metal to influence domestic supply and pricing. The question becomes whether these constraints are temporary disruptions or indicative of a more permanent decoupling between East and West silver markets. What's more, available data points to a shift in storage behavior. In Shanghai, inventories of deliverable silver have reportedly tightened, with withdrawals from warehouses outpacing replenishments. Meanwhile, COMEX warehouses show a modest accumulation, but the metal there is not necessarily aligned with immediate delivery needs. The divergence between physical availability and contractual claims could intensify tension if demand spikes or supply shocks occur. At this point, even subtle movements in either market have amplified consequences. A single large withdrawal in Shanghai, or a delayed shipment to New York, could exacerbate the spread overnight. Analysts tracking these trends suggest the market is approaching a phase where conventional assumptions about liquidity and arbitrage may no longer apply. What particularly striking is the role of domestic demand in Shanghai. Available reports indicate that retail and industrial consumption have surged, with local buyers willing to pay a premium for immediate delivery. Jewelry manufacturers, electronics firms, and even private investors are increasingly sourcing metal from Shanghai warehouses rather than relying on paper contracts or imported bullion. This insatiable appetite is putting upward pressure on prices that New York, with its reliance on futures contracts, cannot reflect in real time. Meanwhile, the traditional link between COMEX and international spot prices is under stress. Historically, futures arbitrage would balance out discrepancies between global hubs. But with physical silver constrained in Shanghai, this balancing mechanism is faltering. Traders note that the arbitrage window is effectively blocked by a combination of shipping delays, customs controls, and regional market priorities. The $15 gap now carries implications for risk assessments, hedging strategies, and even derivative pricing across continents. Compounding this is the growing sophistication of market participants in Shanghai. Reports suggest that local investors are increasingly using domestic platforms to access leverage and structured products tied to physical silver, a practice that amplifies demand pressure while keeping metal off international markets. Meanwhile, New York remains dominated by institutions operating in a paper-heavy environment, creating a bifurcation where the two markets respond to fundamentally different incentives. The tension between immediate delivery needs and contractual obligations raises a critical question: how long can such a divergence persist before structural adjustments occur, either through regulatory intervention, physical shipments, or shifts in market behavior? Current trends suggest the gap is not merely a transient anomaly, it may be a symptom of deeper fractures in the global silver ecosystem. Another layer of pressure comes from the role of government and strategic reserves in China. Available evidence suggests that state-linked entities are actively managing stockpiles to stabilize domestic prices, which indirectly supports Shanghai's premium over New York. These interventions are subtle, often executed through controlled releases or temporary withholding of metal, but they have the effect of creating tighter supply conditions that a global arbitrage mechanism cannot easily penetrate. In New York, by contrast, the narrative remains anchored in contractual liquidity rather than physical control. COMEX inventories are sufficient to meet formal delivery requirements, yet they are less reflective of actual market stress, because much of the metal is earmarked for paper-backed obligations. This disparity reinforces the disconnect between the two benchmarks and complicates the ability of international traders to reconcile prices. Adding to the complexity, available trading data hints at increasing short positions in New York futures as participants anticipate Shanghai's premium to persist. While futures markets are designed for hedging and price discovery, these positions may inadvertently deepen the divergence because they reflect speculation based on expected physical shortages elsewhere rather than immediate supply constraints at COMEX. The interplay between speculative positioning and real-world metal availability is creating an environment where traditional models of price convergence are losing traction. Crucially, the gap carries implications for liquidity and risk management beyond simple profit opportunities. Entities dependent on cross-border silver flows, from refiners to electronics manufacturers, now face uncertainty in planning and hedging. Even small fluctuations in warehouse inventories or delivery schedules could trigger outsized movements, amplifying the underlying tension in both markets. One of the least discussed factors behind the widening spread is the changing behavior of refiners and intermediaries. Reports indicate that some refiners in Asia are prioritizing long-term domestic contracts over spot exports, effectively locking silver into regional supply chains. This reduces the amount of metal available for international arbitrage and reinforces Shanghai's pricing power. In New York, the supply chain remains optimized for financial turnover rather than physical circulation, deepening the imbalance. There's also growing evidence that currency dynamics are quietly influencing the gap. While silver is globally priced in dollars, local settlement mechanisms and capital controls can distort effective pricing. In Shanghai, domestic buyers evaluate silver not just against global benchmarks, but against internal inflation expectations and currency stability. That perspective allows higher nominal prices to persist without triggering immediate corrective flows from abroad. At the same time, logistics remain a silent constraint. Even when arbitrage appears profitable on paper, the reality of moving physical silver across borders introduces delays, costs, and uncertainties that erode margins. Insurance premiums, customs inspections, and compliance requirements all add friction. Traders who once relied on rapid physical movement now find themselves exposed to timing risk, making the $15 spread less actionable than it appears. Taken together, these pressures suggest the gap is being sustained by a convergence of incentives rather than a single bottleneck. Each participant in the chain, from state actors to refiners to speculative traders, is responding rationally within their own constraints. Yet the collective outcome is a market that no longer snaps back to equilibrium. The longer this persists, the more entrenched the divergence may become. What makes this divergence more consequential is how quietly it's unfolding. There's no disorderly trading, no headline-grabbing volatility, just a steady acceptance of two different prices for what is supposed to be the same metal. In institutional circles, that kind of calm divergence is often more concerning than sudden shocks, because it suggests participants are adapting to a new baseline rather than waiting for a correction. Risk managers are already adjusting assumptions. Available indications suggest that some firms now model Shanghai and New York silver prices as semi-independent variables rather than tightly linked benchmarks. That shift changes how exposure is hedged and how capital is allocated. Once markets begin to internalize separation as normal, the probability of rapid reconvergence diminishes and the cost of being wrong rises sharply. There's also a growing feedback loop between physical scarcity and financial positioning. As Shanghai's premium persists, it reinforces expectations of continued tightness, encouraging further hoarding and discouraging exports. In New York, the absence of immediate delivery stress allows paper trading to continue largely uninterrupted, masking the extent of physical imbalance elsewhere. This asymmetry feeds itself, widening the psychological distance between the two markets. The critical uncertainty lies in what happens if conditions change abruptly. A surge in industrial demand, a disruption in mining output, or a policy shift affecting exports could force participants to reassess assumptions overnight. With prices already misaligned, such a trigger wouldn't just move markets, it would test whether the existing structures can still transmit signals efficiently across borders. At this stage, the question is no longer whether the $15 gap exists, but whether the system still has the capacity to close it. Historically, price differentials of this magnitude would attract aggressive capital, metal would move, and the spread would compress. Now capital hesitates and metal stays put. That hesitation reflects a deeper recalibration of risk, where certainty of access outweighs theoretical profit. Available market behavior suggests that some participants are treating Shanghai silver as a distinct asset rather than a regional expression of a global price. When a market begins to command its own premium consistently, it signals confidence in localized demand and control over supply. In contrast, New York's pricing increasingly reflects financial liquidity rather than physical immediacy, reinforcing the perception that the two benchmarks are drifting apart in purpose as well as price. This divergence is also reshaping expectations further down the supply chain. Manufacturers and fabricators who rely on steady silver input are reportedly reassessing sourcing strategies, prioritizing reliability over cost. That shift can entrench premiums, because once supply chains adapt to higher local prices, the incentive to revert diminishes. The longer the gap persists, the more structural these adaptations become. What remains uncertain is how much stress the global system can absorb before frictions become visible. The spread itself is manageable, but the conditions sustaining it, constrained flows, divergent incentives, and muted arbitrage, point to vulnerabilities that may not reveal themselves until they're tested. When that test arrives, the outcome may redefine how silver is priced and moved worldwide. What's emerging now is a subtle reordering of priorities across the silver market. Price discovery, once centralized and rapidly transmitted, is becoming fragmented. Shanghai's premium reflects immediacy, access, and domestic certainty. New York's price reflects liquidity, leverage, and confidence in contractual settlement. Both prices are internally rational, yet they no longer speak the same language, and that disconnect is where risk quietly accumulates. In past cycles, such gaps closed not because markets wanted them to, but because something forced alignment, a surge of exports, a regulatory shift, or a breakdown in assumptions about availability. Today, none of those forces are clearly dominant. Instead, each market is reinforcing its own logic, allowing the spread to persist without triggering an obvious corrective response. That absence of pressure is itself a signal that the system may be operating closer to its limits than surface calm suggests. Available indicators imply that institutions are watching this divergence closely, not as a trading opportunity, but as a diagnostic. A market that can sustain two prices for the same metal is one where trust in seamless movement has weakened. If that trust erodes further, even modest disruptions could have disproportionate effects, exposing fault lines that have been quietly widening beneath stable price charts. The unresolved question is whether this gap represents a temporary adaptation or the early outline of a more permanent division in global silver pricing. The answer depends less on price action and more on behavior, on whether metal begins to move again, or whether the market continues to accept separation as normal. That decision point may already be closer than it appears. If this divergence does resolve, it likely won't happen through gradual convergence or tidy market mechanics. It will happen through pressure, when one side of the system demands physical silver in a way contracts can't satisfy, or when policy, logistics, or confidence shifts abruptly. Until then, the $15 gap isn't an anomaly to be traded away. It's a condition being tolerated. What makes this moment distinct is that nothing appears broken on the surface. Trades clear, warehouses report inventories, prices move calmly, yet beneath that stability, the market is signaling that access matters more than abstraction and immediacy more than leverage. Shanghai is pricing certainty. New York is pricing continuity. Both assume the other will eventually adjust. The risk lies in that assumption. When markets quietly adapt to separation, reversals tend to be sudden. The longer metal stays immobilized and arbitrage remains theoretical, the more fragile the linkage becomes. A system can absorb small inconsistencies for a long time, but once confidence in transferability fades, price becomes less a signal and more a local negotiation. Whether the gap closes or hardens into precedent will depend on actions, not forecasts. If silver starts moving freely again, the spread narrows, and this episode fades into footnotes. If it doesn't, the market will have already answered the question, not with volatility, but with acceptance.